eEnergy is framed as a digital energy services company. We came to the market in January 20 with a view to creating an integrated, I guess, end-to-end services provider that could help all organisations get to net zero and making net zero both possible and profitable without the need for investing capital. So as you can appreciate, this is a hugely topical market. We're facing into massive tailwinds. And the last 2 years has really been about eEnergy building the infrastructure and a platform to be able to offer that unique end-to-end solution in what is a very fragmented market. So I'll be going through our revenue lines shortly and how our proposition is positioned to our customers. But what's interesting to know at the moment is we spent the last 12 months really integrating fully the 4 businesses we've acquired since coming to the market. We've now got a path to launching a central brand in early July under the eEnergy.com domain brand name. And we've got several intellectual property differentiators around our platforms that we've been busy building that is enabling us to be poised perfectly for growth in what's going to be a very, very growth-orientated market over the next few years. Just some sort of key highlights. We have a very large customer base of nearly 2,000 customers, and we have a forward contracted revenue book of 23 million. We're profitable. We've seen strong growth, and we've got a very strong expectation for a H2 growth period. And as you know, our June year end is nearly upon us, so we've got pretty good visibility on that. We don't believe we've got any direct competitors in the market that we're focused. We are particularly focused in public sector, really focusing on both education, healthcare, and local authority organisations, but also in some very attractive commercial sectors in food, logistics and distribution, and in the leisure and hospitality sectors. So the philosophy of eEnergy is to make getting to net zero both profitable but also possible for all organisations. The single barrier to entry for virtually every organisation is access to capital and the fear of execution going wrong to getting to net zero and the pressures of the distractions on their day-to-day operations, whether that's a school or a factory, in, I guess, assessing and choosing and specifying and then delivering the various technologies that are needed to get them to net zero. There's an interesting stat that I think everyone should focus on, and that's 1/3 of all energy which is consumed by public sector and commercial buildings is wasted. So what that means is there is an inherent opportunity for all organisations to reduce their current spend by 30 to 40% just by simply tackling that energy wastage. We're in I guess, an environment now where, and I'll talk to it shortly, where we are in a sustained period of higher energy costs. So our 4 key services are also referenced in language which we call the Carbon Waterfall, and that is, how do you get a customer or an organisation from A to B to C to D, their energy transition to net zero, without them having to deploy their own capital. So the first is moving them to procuring the lowest cost clean energy. And this is a very, very important factor in reducing your carbon footprint. It is no longer about, can you buy your energy for a decimal point cheaper through one platform or from one provider. It is now about, how do you access clean energy through renewable sources at the lowest cost, but also how do you use less. So our platform is partly inherited by one of the acquisitions we did in 2020, which is the Beyond business, which has a unique platform in the market that allows us to offer our customers a platform to tender their energy contracts, and that gives them full transparency to all the suppliers in the market that bid for their contracts. So with our offer, we don't target the SME sector. We generally target customers with an energy bill of £250,000 or more, either for their single buildings or for their portfolio buildings. And we've got circa 2,000 customers in this particular space, strong gross margins of circa 80%, 85% retention rate, and the average life of our customers is somewhere between 6 and 7 years. So we have a very reoccurring revenue base here, and one of the real key focuses of our M&A plan originally was to not only access what is a very interesting and differentiated proposition in this transition to clean energy, but also to be able to access customers that we've got constant dialogue with, from which we can then create downstream revenue opportunities, which also tackles the whole energy transition to net zero. So once we have, and I'm talking in the language of a particular customer, which I'll reference in a minute, which is the typical journey we take all our customers on, switching them to the lowest cost of clean energy is, if you like, priority one. Priority two is to focus on tackling energy wastage. There's a misconception in the market that smart meters provide you with insight. The reality is they don't. Most people, when they think of a smart meter, think of a digital reading that gives them the equivalent of what they're used to getting through paper or through a analog reading in a digital format on a half-hourly basis. The reality is that doesn't really give any insight to your consumption. What you need as a building owner or operator is visibility of your energy consumption behind the meter, which gives you circuit level consumption data, so you can see where in your building portfolios you're consuming and therefore wasting energy. So we have a proprietary platform. It was a business that we acquired called Measure My Energy. It's been rebranded as My Zero. I'll show you some screenshots in a minute of what it does and how it works. But in essence, what we are providing our customers is the ability to get an itemized real-time energy consumption visualization in the form of a software platform which they can access at any point. And that platform can give automated reports on a weekly, monthly, quarterly basis that will highlight those areas against their peer group, against out of hours, against particular trends that we've set that illustrate quickly those areas where either they've got high offenders of energy consumption or out of hours consumption. And we've got evidence now that by providing visibility to any building operator where they're consuming their energy, gives them the opportunity to be able to reduce their spend by 10% with zero cost action. So in other words, behavioral changes, which really means being able to use the data, which is easy to understand, to be able to manage their buildings better through their facilities teams. We sell this solution as a service, a software as a service proposition, either wrapped up with our if you like, clean energy procurement platform, or through a simple subscription to customers that we're tackling through other services. And to give you an idea of how important this is, our customers so far this year have demonstrated this really is one of our fastest growing parts of our business. And I'll talk through some of the data we've got in a minute. Once the customer has got visibility of their energy consumption and therefore effectively a sort of almost a roadmap to tackle energy wastage, we can then deliver our third service, which is all around reducing consumption. This really was where the core of our original business was established. So we've got over 9 years experience now in the energy efficiency as a service sector, which really means deploying energy efficiency solutions, whether that's lighting or HVAC or other forms of energy efficiency as a service, which really means we deploy the solution using our funding mechanisms. We take the specification pressure away from the customer, we design and implement, and we then operate that solution over the course of the term, which is typically 7 to 10 years. And the customer is using the savings that they're generating from that technology to pay for our subscription fee. And typically it works out that the customer's retaining a third of the savings net, and we're getting 2/3 of the savings. So they are always cash flow positive from day one, month one, year one. And it means that effectively it allows us to live up to the promise that getting to net zero can be profitable. And that really is one of the main levers that we pull for our customers. To give you just an example, a typical 10 school portfolio will have seen its energy costs rise from what was a circa £1 million a year portfolio cost to £2 million a year portfolio cost. And through our solutions, through both the energy visualization using the MyZero platform and the lighting as a service and other energy efficiency measures, we've been able to get a typical portfolio reduced by 50% in terms of their annual consumption. So you can see how these numbers are starting to really become very meaningful, even for relatively small portfolios. And then the final piece, which is one of those exciting parts of the growth story that we have now, is on-site generation using effectively PV, solar, and either with as a package or in isolation, EV charging as a service. And so to put it into context, at the moment, if a customer is buying grid energy, they may be paying anything between 25 and 30p per kilowatt. And if they're buying solar energy through a power purchase agreement, which is the typical construct of how we would wrap up a self-funded solar solution, they would pay somewhere between 13 and 15p. So 50% reduction from grid as a result of being self-generating. So really it is a case now where customers are now talking to us about how much solar can we generate on our portfolio, and how quickly can we get access to that. And we've got some really exciting growth stats in there. I've got a quick snapshot here of a commercial customer where you can see how these revenue lines translate to us. This is a recycling business with 20 plus sites. I've referenced this customer before for those that may have seen some of my presentations. We're now on the full journey. So we are just over a year into the relationship with this customer, which we won from a competitor energy consultancy who was supplying services in traditional utilities management. We moved this customer from brown to green energy through our platform. They paid us a retainer to do so with full transparent pricing. You can see the revenue line to us over 10 years is about $500,000 for that customer. We've then delivered a energy insights MyZero package, which is circa 24,000 a year. So you can see that there's a 240,000 10-year revenue line there for us. We've delivered full end-to-end energy efficiency, voltage optimization, and HVAC solutions wrapped up as a service. That's worth over 1.1 million to us. And we're in the process of delivering a full multi-site solar and EV charging solution, which is actually, as of this week, likely to be somewhere in the region of 1 to 1.5 million. So you can see that the combination of all the downstream revenues for this customer is going to be in excess of £2.5 million. And we would call this a mid-sized customer. So as a result of having our multi-service offering, we can take what would have been a single revenue line customer in the eyes of one of our acquired customers, and we can then get 4 to 5 times the volume and value out of that customer, but more importantly over a 10-year horizon, which for us is a reoccurring and predictable revenue line, which we think is incredibly attractive to investors. I want to just touch briefly on the MyZero piece. It's an incredibly important piece of technology. It's proprietary technology that we own. We both own the hardware and the software. We outsource the manufacturing of our smart meters to a contracted electronics manufacturer. They provide the full end-to-end solution to deliver that fully boxed to us, so we don't take any of those execution risks of being a manufacturer. We have an in-house software team that develops and has been developing the MyZero, what was Measure My Energy's platform. It's an incredibly innovative and incredibly easy to use graphical user interface, which means that a unsophisticated user can quickly grapple with what the data is telling them. I think one of the biggest problems of this sector is that a lot of data becomes available from many parts of portfolios, And I think that the importance is simplification of the really key important drivers that can make a difference in the journey to, if you like, navigating to net zero. So I think for us, this is a really big value driver. We've seen some really exciting, I mean, we launched this less than 4 or 5 months ago. We've already got 522 meters under contract with just under £1 million worth of contracted revenues. From a standing start now, we're nearly at 2.6 million of pipeline opportunities with existing customers. So these are not cold customers. These are existing customers that are layering in additional services. To put this into context, from a peer group comparison, there are only a handful of platforms like this available in the market. Centrica bought probably the most similar platform, a company called Panoramic Power, and they paid $50 million for that. I think it was $60 million actually in 2018 for a business that was arguably at the time less sophisticated than where we are now. We think this is a real gem. We've really worked hard to get it to a point where it's easy to navigate for our account managers to understand it, and really easy for our customers to engage with it. So we think this is going to be a real innovator for growth for us and a real differentiator against our kind of general competitors in the market. So just to touch on what we think are the organic growth drivers of this business in these 4 pillars of services that we offer. In this procure stroke accessing clean energy, clearly even the uninitiated in this market understand that there is a massive demand for zero carbon energy, whether that's driven through governance, compliance, or supply chain, or all other kind of sustainability drivers. And we see that we can take a market-leading position in providing effectively a platform of agnostic pricing to our customers to give them both the best solution at the right price, but also using that to leverage these other efficiencies that we've got. And because of the platform, I guess, capabilities, we've been able to drive quite a lot of what I would call process and systems efficiencies in the integration of the utility team acquisition that we did, merging with Beyond. So as a result of those 2 businesses coming together, we're now ranked 5th in the UK in terms of we're the 5th largest energy management procurement platform business in the UK. We manage just under, I think, £1.5 billion worth of power for circa 2,000 customers. And some of those customers are, for example, multi-site procurement platforms. So we manage the entire portfolio, for example, of Knight Frank's, property management clients, and we've been doing that for nearly a decade. So that's our kind of the key growth drivers. There are that whole sustainability, zero carbon, clean energy need. The growth drivers around measurement, I think, are clearly articulated previously, which is all around this focus on energy wastage, given the huge drivers now for, I guess, reducing energy costs and understanding how they can use those to effectively, self-fund their route to net zero. In the reduction part of our business, we see the key drivers again, partly driven by high energy prices, partly driven by people's awareness of how blind they are around where their energy optimization opportunities are, and linking measure and reduce together is actually a very powerful combination. And we think that moving into some adjacent technologies outside of lighting and HVAC, such as, for example, the electrification of heating, could be a really another big bounce of the ball, so to speak, from the existing customers we've got that are now looking to go that next step further by either using government grants or other funding solutions to get their heating and decarbonisation of heating down. And then lastly, generate. As I said, the grid is now twice as expensive as solar generation. There's clearly been an accelerated explosion of demand for electric vehicles, both across the fleet sector, but also to the individual consumer that is now demanding, if you like, infrastructure charging from their employers. And we're seeing pretty much all of our customers being actively involved in consideration with us around this whole EV charging space. Before I go on to some of our current sort of trading metrics, just to mention the current energy market. Clearly, we've been in a very volatile market over the last few months. I think that has caused some digestion for us, or rather indigestion for us, as a result of customers not knowing how to manage this market volatility. What I think it has shown is that the sophistication of our risk management and consultancy service have been almost like a flight to quality advice. So we've been able to effectively use the volatility of the market as almost like an inflection point for us to get strong client traction. Clearly, the situation in Ukraine has driven a huge supply and demand issue, where now that we have got this expectation of higher energy prices, I think customers are now recognizing that the period over the last few years of pricing is not sustainable going forward. And I think that's going to be something that just increases the tailwinds for our business going forward. Just to touch on the M&A strategy to date, I think it was clear that when we came to the market, we wanted to build a really clear, cohesive platform. We've done that now, and we've got a great platform from which we can grow organically. I think what we have bought, we've bought well. I think the results to date have demonstrated we've been able to sustain good organic growth. It's fair to say that the first half-year results were slightly disappointing for us, and I think probably there was a sort of knock-on delayed effect of COVID impacting our sort of new business generation in the early part of 2021, which we are clearly bounced back out strongly in this current period, which will be reflected in our sort of H2 results. So I'm really happy with the acquisitions that we've acquired. We've seen strong integration. We've seen the strategy of our 4 pillars come together and being adopted by our customers in a really strong, cohesive way. And I think that we're now going to see a period of sustained organic profitability growth that we can drive forward based on all the factors we just talked about. We've got a few key metrics that I think you may have seen from some of the RNS announcements that we've had out over the last few months. We've seen significant improvement in the revenue per meter that we've grown organically, up 37%. We've achieved an increase on our contract duration, so we started extending historic contracts by up to a third, and we've seen some of our historic customer fees increase by nearly a third as a result of these additional services we're adding on. So we have really worked hard on our top, what I call strategic accounts, and we've got a very, very, very advanced pipeline now of projects with existing customers. So we're starting to see traction of those existing customers in, for example, procurement, start to engage at the consideration stage on downstream energy services that we've got to offer them. And I think that's going to start flowing through in our results in the coming months. I'm often asked by investors, what are our current plans for acquisition? I think, given where our current share price is, clearly what we've got to do is we've got to go through a period of stability and organic growth before we start thinking about future acquisitions. I think we are very clear on the profile of acquisitions and the profile of an acquisition within a subsector of the environment we look in, and that is definitely with a focus on renewables and in particular on-site solar generation. We've got a couple of very strong partnerships in this place, in this space rather, which I think puts us in a good place for future conversations around potential acquisitions. We look for people to join us rather than sell to us. I think that's been one of the formulas that has worked very well for us historically. And I think what we're looking for is the right structure of deals that can give us that balance between using our paper when it's priced correctly, but also having our acquisition targets wed to mid to long term timeframes with us over a 2 to 3 year period, without them effectively cashing out in the near term. So hopefully that gives some flavors to what we might look at over the next 12 to 18 months. But I think in the near term, I think we're actually more focused on organic growth and getting that profitability coming through in accordance with the guidance that the research notes that we have out on eEnergy at the moment would also support. So just to that, referenced H1. I think, look, we probably were quite disappointed with the H1 results, despite seeing 42% revenue growth. I think there was some delay in project conversion, which we're going to start to see picking up in H2. We moved into a period of profitability, but I think what I really want to focus in on is the forward contracted order book that we secured, the sales contract commitments that we secured, that will then start reflecting in revenue as we move forward into the second half of this year. And our full year outlook is guiding 23 million, which will show a 70% uplift from last year. And we're guiding 3 million EBITDA, which will be up 250% from FY21. So from that perspective, I think that is our focus. That is what we are very focused in terms of how we build strong investor support. We've got a really engaged pipeline of existing customers, and we're also pleased that we've got a couple of new partners with Silicon Valley Bank as our new debt partner, but also having recently engaged Suzy, who is Europe's largest energy efficiency fund, who are now supporting us in the UK, and who are very motivated to build out a longer term, really quite significant project funding relationship with us as we move forward with multiple technologies, stretching from not just lighting, which is what they've historically supported, but moving into metering, solar, and also EV charging.
We've run out of time, but I will squeeze in a couple for you. eEnergy has a fake model operating in the right space at the right time. Why is the share price so low? Makes no sense.
Look, I completely agree. I think we've been unfortunate. We did a downgrade, which was unfortunate as a result of perhaps a little bit of over optimism at the beginning of the year. I think that the trading will speak for itself in the coming weeks and months, that will get us back to where I think we are correctly priced at.
Have your inquiries grown substantially since the recent steep rise in power charges? Can you fulfill all the demand?
So on the demand side, absolutely. We have a huge network of national contractors now primed for growth. We've demonstrated over the last few months, as you'll expect, the H2 expectations were significantly skewed towards growth versus H1. Over the last few months, we've demonstrated our capabilities in the area, and we are seeing much stronger sales growth than we originally expected as a result of this high energy price environment.
Okay, I'll throw in one more. As I say, I'm over time. Is the Ireland situation improving?
So look, Ireland is in two parts. So in the Northern Irish territory, we've effectively we've dovetailed that into our UK sales strategy now, and we've got strong traction in Northern Ireland in the education sector. The Southern Ireland market is not surprising, a much smaller market. It has rebounded much slower than the UK. I think that we've got some interesting opportunities for some key large customers, but we do not see the growth coming from Southern Ireland going forward. We see there being stable revenues, but the real stratospheric growth that we expect to see will come from the UK market.